Thanks for downloading our overview guide that runs to something like 18 pages. So with that in mind, I thought I'd provide you with a quick video highlighting some of the key points in our consumer duty overview guide, just to make things a little bit easier for you. The guide starts off by setting the scene as to why the consumer duty has been brought in, essentially that treating customers fairly failed. We point to many examples of products and services in the industry not working well for customers. So whether that's payday loans, the rent-to-own sector, pensions, or insurance pricing, where the price of people's insurance increased every month. The practice of price walking, despite the fact that individuals were no more of an insurance risk than what they were last year, just essentially being penalised for loyalty. That sort of practice that highlights the fact that many products weren't working well for customers, either in terms of the price or the nature of the product itself. So as a result of all of that, the regulator determined that TCF had failed and it needed the stronger, more robust consumer duty. That's worth including in an overview guide simply because it gives you the background and reasons that the duty has been brought in, and then everything you do as an organization to implement the duty, you can keep that in mind because, of course, that tells you, if you like, the goals that the regulator has in respect of the duty. So then we have a section covering the scope of the duty. You may have some products and services in scope, some outside of scope, so you can have a little read through that section to identify what you do have in scope. But generally speaking, the duty only applies to activities under the FCA's supervision. So therefore, activity falling outside of their remit, so unregulated business lending, for example, is not typically subject to the duty. Saying that, it's a little bit more complicated because some unregulated activity can actually fall within the scope of the duty. So, for example, where an unregulated activity is required as part of the delivery of a regulated activity, i.e., it's an ancillary activity, then it can be or will be within the scope of the duty. However, the sale of an unregulated product separate and completely distinct from a regulated product, even if it's sold at the same time, is not subject to the duty, just to highlight that point. So we talk about that, and we also define what's meant by a retail market business and how the duty applies to wholesale markets as well. But the bulk of the overview guide is focused on the product governance framework because that is the essence of the consumer duty. And the product governance framework begins with the product approval process, which is a key document or a key procedure that you will need for your consumer duty compliance. What the duty expects you to do whenever you do create a new product or service is firstly determine whether it's within scope of the duty. And if it is, understand the key intended benefits of your product or service. And in particular, who are you aiming it towards, or who is your target market for this product or service? Then, once you've identified that target market and doing that in detail, undertaking that foundational thinking is absolutely key for consumer duty compliance. Once you've identified your target market, you then understand their characteristics. So, what are the characteristics of customers typically in that target market? So, for example, if you are providing, say, a kind of credit repair product uh, for a credit card, for example, then you would look at the characteristics of customers that would typically purchase that credit repair product. They've obviously had poor credit history, therefore, perhaps in general, they are less experienced with financial services, less capable of managing their financial situation, and generally maybe less well educated, have lower reading levels or lower reading ages, and so on. Now, that's very much a generalization. That's okay though. And you will have customers that don't fit that description within your target market. And again, that's okay. But we are looking at who your average customers are. You may well also decide to group your customers. So you might You might, if you like, anticipate that 60, 70% of your customers are going to meet the characteristics of that, less well-educated, less capable customer, whereas you might have 20% of your customer base well-educated, experienced with financial services, but have fallen upon hard times, and maybe 10% vulnerable customers with certain types of characteristics of vulnerability. So you set out, in this case, three core groups, but it might be four, five, six, seven. Once you've done that, you then apply the cross-cutting rules under the duty. So that's for the foreseeable harm, you must act in good faith, and you must help customers pursue their financial objectives. So foreseeable harm is the most obvious one to start with and the easiest one to start with. Now you've identified the characteristics of customers, such as the low reading age example. They can then obviously see what harms the customers could get as part of your product, not understanding the product, falling into further financial difficulties. So when you identify those harms, you can think of the solutions that you put in place as part of the creation of your product or service to mitigate the risk of those harms. Clearer explanations as to how the product works, more information given early on, staged information in bite-sized chunks so that they can or have a greater chance of understanding it, for example. So start to bring in those solutions based around their characteristics. You do exactly the same with good faith and supporting the customer's financial objectives. We then create a product that we think is going to work quite well for customers, but of course we need to make sure we're charging fairly. That's the next step, if you like, in our product governance framework. That's the price and value outcome, and that is, of course, our value assessments. As part of that, we very much focus on the content of the value assessment as part of this overview guide. We call out the fact that the key elements you need to consider when conducting a value assessment or how to identify the price paid by customers. So the total cost, including not just the money that the customer is paying over the lifetime of the product, and that's a key element. It's got to be the lifetime of the product, but also they pay with time and data as well. So you've got to factor those in terms of the price paid by the customer. We then explain the considerations when you assess whether your price that you're going to charge is then fair. So that could be market comparisons, although worth pointing out that the FCA has told us that market comparisons alone shouldn't be used. So you must also use things like quality of the service that your firm is going to provide and the cost to your firm for providing the service. They are the basic elements of justifying your price paid. But then it's also important as part of this assessment to ensure that customers get what they pay for. So if you are offering 4 or 5 key benefits of your product or service, that you actually deliver those to the customer. Otherwise, they are paying for something that they don't receive, and under the duty, they should then receive a refund. So making sure they get what they pay for and that they understand the costs involved. So it comes back to that communication and understanding point of view. They know what the price is. The pricing's clear. It's not opaque in any way. If it is, amending your pricing structure so that it is clearer for customers and being able to demonstrate that thought process, and maybe an initial proposal of how you'll charge. You've thought about it, and actually you think that's quite opaque for customers, so therefore you're going to charge in a slightly different way. Demonstrating that thought process to the regulator as part of your value assessment be very beneficial should they ever ask for it. You can also include in your assessment comparisons of groups of customers in the target market. So those kind of 3 groups that were said before, and would they pay the same, or could one of them end up paying more for various reasons? And would they receive the same level of service? Because that's what we're working towards. Fair pricing, whereby customers, just because of their characteristics, shouldn't be paying slightly more and receiving the same service as other customers. And they're all key parts of your value assessment, which we explain. Once we've done that, we then create our communication suite. And you can see a lot of what we've talked about is thinking about who our customers are, what their understanding is, and therefore what they need to be told. That is the communication outcome. And the key difference, probably under the duty compared to the old rules, which was Principle 7, to be clear, fair, and not misleading. Under the duty, we need to make sure that our communication is understandable for the target market. So that's a subjective standard compared to the previously objective standard, clear, fair, not misleading to the average person, the average consumer in the UK. If they read it, read your business communications, if they see your financial promotion, would the pricing, for example, and the key benefits and risks of the product, would that be clear and obvious for the average person? Now we need to write it in a way that reflects the information needs of our target market, and that gives them, if you like, the right information at the right time in order to make informed decisions. Now we will create our communication suite as part of creating a product or service under the duty. We'll create it the best we can to the information needs of customers, but you can never quite tell whether you've met that. It's very difficult for you to put yourself in their shoes. So one of the requirements of the duty is to undertake testing at that point in time. So that can be A/B testing against current customers that you might have, or it can be using things like focus groups. And I know some firms have selected staff members who have similar characteristics to the customers that they are going to be providing this new product or service to, and tested the communications on them. So to see basically what it means to those individuals and tweak them from there. All of this together is basically building a process, a set of policies, procedures, communications, which is your product and how you're going to deliver your product. Now, some of that will be delivered by your company, and some of it may be delivered by suppliers or other organizations in the distribution chain. So in that case, creating a distribution strategy is your next step. You then release the product, release it to the market, and hopefully it's working well as you expected, but you never quite know. And as always with compliance, you then need to monitor how well the product is actually working in the real world. What outcomes is it delivering for customers? Is it working as we expected, or is it very different? That's your outcomes monitoring. And again, that's a bit of a focus area in our overview guides. One of the key areas that firms need to focus on an ongoing basis and try to get right. It's quite a difficult area as well to get right, similar with value assessments, really. But with outcomes monitoring, I think the main thing I could say on this video is to think of it as a process to understanding what you should monitor, rather than almost like a defined list of MI that the FCA expects. So I think a lot of clients that I work with say, well, what data should we be looking at? Should we be looking at complaints and root cause analysis? Should we be looking at business persistence data, drop-off rates, default rates? What should we look at? What do the FCA expect? Well, they don't expect any specific data. Instead, what they expect is you to go through a process. And that process starts with understanding what good looks like for your customers. So with your product, what does a customer using or purchasing your product, what does good look like for them? What's their aim and objective? Do they get that from your product? What data tells you whether they got that? And then you identify what data, ideally you already have, that tells you whether they have got that outcome or not. Now, if it takes you 4 or 5 bits of MI to give you that story, then that's all you need. If it tells you whether the customer is getting a good outcome, then there's no point in having an additional 5 bits of data that just back that up. If 5 pieces tell you the story for the customer, then leave it at that. Although what we've talked about there is one average customer, so maybe the average person in the target market, did they get the benefit from purchasing the product? What you then need to do is spend your time looking at different groups of customers, so customers with different characteristics. So, we group 3 before in our example, vulnerable customers, for example, are they getting the same outcomes as non-vulnerable customers? Are customers with a bit more experience with financial services? Are they getting the same outcome as customers with less experience? If you're identifying a difference, that means you could go back, look at how you're communicating with customers, look at how you're supporting them during that onboarding process or after that, wherever the issue may be, and then tweak how your product works. That's the whole goal of the outcomes monitoring piece. So, yeah, we can look at average customer, but also look at different groups of customers too. You may also take a third lens, if you like, through your outcomes monitoring, which can be looking at what the customer needs or the outcome they want at each stage of their journey with you. So it's not just their use of the product you're thinking about, it's the action that they are currently undertaking, whether that's application stage, whether that's raising a complaint, or perhaps raising a query. And at that stage, you can look at, say, if we use the query example, when a customer raises a query, what outcome do they expect? A timely response, correct response, a response that covers all the items that they've raised in the query, for example. Have they got that outcome? So you can look at it from a customer journey point of view which is really, really beneficial in terms of identifying areas that you can improve. And don't be frightened to have things that you can improve as well. If the FCA include you in one of their multi-firm reviews, or if they undertake a Section 166 investigation against your firm, which they are doing quite a lot at the moment, it's good to be able to deliver to them the areas that you have identified as things that you can improve within your product or service, rather than just everything's rosy, everything's fine, we think we've got a perfect product. What they are looking for with the duty is that it makes us very much examine our products and services, examine what we do and improve. So if we can deliver a few of those areas of improvement, that goes a long way to, for want of a better phrase, placating them. But after the outcomes monitoring, you can see that you end up with quite a lot of MI. That can be used as part of your board report. You obviously need to report that up your governance structure to the relevant forum to demonstrate how well you are providing products and services as a business, where your issues are, and what you're doing to fix them. That can be also backed up by a product review, which can be undertaken at relevant intervals, perhaps pooling together the MI from your outcomes monitoring to formally review the product every few years to check whether it is functioning properly. But nevertheless, all of that needs to be brought into your annual board report, so your board are updated on your progress. And again, that's highlighted as part of our guide. So as we say in the overview guide, there's a lot to take in, and that's just the overview of it. So whether you're embarking on your consumer duty journey or simply looking to review your compliance level, I would like to let you know that we've supported solutions that can meet your needs. So whether it's our consumer duty continued support service, we're able to discuss your needs to tailor our support for you. So that might include a gap analysis review of your product governance framework, looking at everything we've just talked about. It could be evaluation of your assessments or hand-on support forming your outcomes monitoring framework. We also have a really useful range of templates available, such as a board report template, value assessment template, product review, product approval. They're all available to purchase on our website and act as a good starting point that you can build out from there for your own firms. And we're always available should you have any questions. Thanks for listening, and we'll hope to be able to support you going forward.